but it's okay to be where you're at. And look, this is a career path and it takes years to kind of evolve into this business.
Right.
Do it slowly, do it correctly, and you can become pretty wealthy,
Right.
but you got to be willing to grow in it. You don't have to get it all done today.
Tim is one of the most authentic and genuine people I've ever met.
Sincerely believe he's coming from a position of giving, and that means a lot.
You're going to make huge progress.
Welcome, everybody, to today's Capital Raising Show. I'm your host, Tim Mai, and today I have an amazing guest on the line with us. He's a very experienced architect for 30 plus years, I believe, 38 years, almost 40 years. Holy cow. So he's been doing this for a long time, the architect side. However, the syndication side, he's only been in like short few years, but he has been making tremendous wave across our industry here, doing acquire over $500 million worth of asset and personally raised over $26 million and with his team over $110 million. So amazing track record in a very short amount of time. So I'm super excited. Let's give Mr. Mark Shuler a big welcome, y'all. Woo-hoo! Awesome. All right, thanks, Mark.
Sign claps.
I know we need to do like come up with some kind of virtual Zoom clap for you. Oh, a soundboard. That's what I need. All right, next time.
I've got a soundboard. I could have kicked it in. I don't know if y'all can hear it. Let me see here. Yeah.
All right.
Did you hear it?
Yeah, we heard the music. We're looking for claps, but that's okay.
I can't hear it.
You can't hear it? Okay.
Oh, no.
Yeah.
Are you serious? Sorry, guys. I was like, oh, it doesn't work.
Wrong soundbite. So Mark, as you can see, we like to have fun on this show.
Yeah.
I'd love to hear your story, but before we go into how you got into this commercial space, I want to give everyone a little bit of background on you, because you must be like super very prepared, very detailed. I've done. So we started doing these interviews since July, and I've done probably around 15 interviews now, and no one has ever wrote out the answers to every question that I said.
I am basically an engineer, so I like to be prepared, and I'm very detail oriented. So that's how I roll.
Yeah, that's good. It definitely shows, and I appreciate that. Just keep in mind, I won't be asking you all those questions. I use it as a guide, more so than exactly what I'll be asking. But I'd love to start with how you got into this business, and what had you made that transition from being an architect to now a syndicator.
Well, yeah, I got in the business about 8-10 years ago. I had been a practicing architect for a long time, but I'd always felt like that was a stepping stone into this industry, which is where I always wanted to go. My background is, yes, as a practicing architect, but I also have an advanced degree in real estate development from University of Washington's business school. I did that about 2001. And then everybody in my family is, a lot of people are in the industry. So I have 5 family members who are commercial brokers. My kid brother is probably the foremost authority on real estate taxation in the entire country. He's a managing partner of one of the largest accounting firms in the country. And
oh, wow.
He's their real estate guy. So we just tried to hire his firm to manage our business. We're still kind of seeing who's going to win the beauty contest, but he's very competitive. And I just know a lot of people in the space. I've worked with a lot of developers over the years. I've worked with a lot of home builders. Obviously, I had a lot of private clients. I've designed some very large multifamily projects here in Seattle. The way multifamily works in an urban area is a little bit different than in the southern part of the country where the sand states where they have more land than zoning. So we tend to design very tightly conceptualized urban blocks here with a lot of underground parking. So they're very, very complex projects. I've done 3 or 4 of those big apartment buildings, 200 units with probably 200 to 300 units of parking on below grade. And so just very complicated projects. Cut my eye teeth in the apartment game doing those, and it just always wanted to be in the game. Since then, generally I figured out I was a lot smarter than the guys who were hiring me, and I was making them all the money in the world, and they're basically paying me a fee and not nearly what I was worth. So ultimately I made the transition 10 years ago into the industry, started doing deals myself. My first deal was a little 30-unit deal. We bought it, renovated it, flipped it, made a nice 22% IRR on that in 3 years. Now, we're buying big 500 to 1,000 unit portfolios. So,
Wow.
it's an interesting game. We're in a very challenging time in the marketplace. We'll see if there's going to be good opportunities going forward.
Right. That's awesome. Now, you've been in the industry for close to 40 years. However, you only been as a syndicator for 10 years. During that whole time before you became a syndicator, did you consider it at all? And because where I'm trying to get to is this. For me, I got started in single family home 20 years ago, and it took me this long, 20 years later, to finally said, oh yes, I'm going over to to multifamily syndication space. So I'm curious as to what that. And for the longest time, I just thought, it's too complicated. The deals are too big. I like my small deals. I'm comfortable with them. I know I can do it in my sleep, kind of thing. So I'm curious as to if you went through a similar process, before you finally made that leap.
Yeah, for like a New York minute. I, in addition to everything I've done, I work with house flippers, and I saw the struggles they went through, and it's like, that's not for me. This is not a scalable business model. And at the same time, look, I just wanted to go play in the NFL right away. I just didn't want to screw around with house flipping. And what I figured out about house flipping was a house is worth exactly what some knucklehead is willing to pay for it when you're all done. Yep. And that's it. You can't value it. It's just valued mainly on comps with the other product available in the marketplace nearby. What I find, and it just tickles my engineer's mind, what I love about multifamily is it's valued on multiples of cash flow. And so there's a lot of analysis involved in it. The underwriting is very intense. My underwriting is sheets and sheets and sheets long of interconnected Excel spreadsheets. And so, we are basically trying to build a financial model for the asset, 1 to 10 years out. And so, I personally think you can't project more than 3 years into the future, but it's an interesting exercise that I enjoy. I'm basically a numbers guy, so I like doing that, but you can get lost in the abstraction of Excel all day long. So you got to keep it real. And that's where my, building background and my operations background comes into play, because I can sort of check myself when I get too crazy with the numbers and just get back to, let's just get it down to earth here and let's see what's real. So it takes some experience to kind of know. I mean, you can get lost in garbage in, garbage out real quick in Excel. So you got to be very, very realistic about your projections. So, you kind of go through this iterative engineering process back and forth. But to answer your question, I've never flipped a house in my life and never intend to. I just, that's the bigger pockets model, their Burr method.
Yep.
I just prefer that to use the Burr method on a 1,000-unit portfolio, which is what we
Right.
do.
That's awesome. How
It's a
big
lot
was
more
your
profitable, I'll tell you that.
right? How big was your first deal?
It's only 30 units.
30 units. Okay.
Just a little 30-unit deal, and then I did a 40-unit right away after that.
Okay.
And
So what?
it took me a minute, but then I found a 14-unit deal, and man, that was really profitable. So you don't have to buy these big deals to make a good profit. I made $700,000 on a 14-unit deal.
So were all those deals syndication deals?
The first two were the 14-unit I did on my own.
Gotcha. Okay.
And
so
then we've syndicated everything since then.
Yeah, I see. Okay. Yeah, I'd love to hear about your experience with, capital raising on those first two deals. With your background, did that help you a lot in having your investors trust you and invested with you in those deals?
Yes and no. So the hardest part about becoming a syndicator, especially your first couple of deals, is credibility. Because if you've had a W-2 doing something, and all of a sudden you're getting into real estate syndications, you've got to convince people that you know what you're doing. And how do you do that if you have no experience? So that's the toughest part of getting going in this business. It becomes a lot easier once you have a few deals under your belt. People start to recognize that maybe you know what you're doing, and they're willing to deploy some capital with you and test drive a relationship. The way I did it was to partner with guys who were really experienced. So I was very strategic about how I went about doing it. The one thing I'll kind of give your audience is, like, real estate is a team sport. And for you, those of you who think you're going to go out there and do it on your own, I got news for you. It just doesn't happen that way. It does not happen that way. You cannot possibly wear all the hats that are required to syndicate a big deal. And so you need to kind of divide and conquer. You've got to be able to have people who have specific roles in the deal and can take on those roles, but to try to do it all yourself is impossible. So I partnered with folks who had a lot of experience, and then I had to go out and raise my tranche. So with a little 30-unit deal, I believe my tranche was like $900,000. And when you're first starting out, that's a lot of money to try to go out and raise, because all you're doing is hitting up friends and family. But, we kind of ground through it and figured it out. And slowly I've built a methodical process and systems that I utilize for my raises. It's a lot easier now. But to your point, Tim, my architectural background, believe me, I use that all I can to gain credibility with potential investors. I have a YouTube channel and a LinkedIn profile. My tagline in there is the architect of real estate. So I'm trying to tie my two careers together and brand myself. And it works. Gotcha. It really does.
That's really great. So let's go segment right into that. Do you attract a lot of architects as your investors? Since no,
architects are stupid. Really, they who the hell knows what goes through an architect's mind? But the one thing I always had going for me is I have a strong business sense. And, my dad was a businessman. My grandfather ran a mechanical contracting business through the Depression. My uncle took it over and ran it his whole career. So we've always been in, it seems like everybody in my family has been in construction or real estate one way or another for generations. And we've all run our own enterprises. Like, I have 5 siblings, and 4 of them run their own businesses. So, and I run my businesses. I have 2 businesses I run. So I have a pretty good, strong business background, and I'm part of masterminds and mentoring groups that coach me to kind of take it to another level.
Right.
But, architects don't think like that. They're generally, W-2 guys. So
Gotcha. Interesting. Okay. So who would you say is like your top three biggest categories or avatars of investors that invest with you?
I'm really stupid when it comes to the avatar thing. You know, I guess I should get better at it. But the top one that I'm pursuing right now is ultra high net worth individuals.
Okay.
I'm
So it doesn't
talking.
matter your profession then, just as
I
long
don't
as
give a
they.
shit. I don't
Okay.
care. But I'm looking for people who can write multiple 7-figure checks, and believe me, I have some of those.
Wow. So let's talk about that. So what is a profile of an investor that is able to write 7-figure checks?
They are super successful and super busy. You can't get to them. You can get to their people, and maybe their people will kind of allow you to have an introduction with a person like that.
Mm-hmm.
But in general, these people are running large companies,
I see.
or they're extremely busy doing something. And so it's not like you can just have a meeting with, you don't find these people, all right? You get introduced to them, which is how it's worked for me. I've been introduced to these people by other people. But I'll tell you, the mindset of these people is entirely different than your average retail investor. Average retail investor is looking to build wealth.
Mm-hmm.
These folks are looking to preserve wealth. It is a totally different mindset, and you have to tee up a deal that caters to them, that addresses what their needs are. So what you want to talk a lot about is mitigating risk and how they're not going to lose their money because they've worked hard to earn it.
Mm-hmm.
And it's, and believe me, I learned that as a practicing architect. I did homes for 4 senior vice presidents in Microsoft in the 90s. These are people who are all worth multiple 8 figures, actually multiple 9 figures. And I also did a house for the guy who was the number 2 at Intel in the 90s at the time.
Wow.
They have a B in front of the illionaire, not an M for millionaire. Mm-hmm. And so just the mindset of these people, that generally they're pretty nice, although the folks at Microsoft in the 90s ate their young for lunch. But generally they're just, you learn to not put them on a pedestal, and you learn to communicate with them, and you learn to be very, very specific in what they want addressed. They don't bullshit. And so they don't have time.
Right.
So you are very matter of fact and business-like with them and treat them professionally, and they do the same for you. So
gotcha.
You can't get too intimidated when you just deal with these people. They're just normal people who just happen to be uber wealthy,
Right. So with with their goal being more about preservation of their wealth, would it make sense to offer them more of? So I'll give you an example. I have a friend of mine. He runs a fund that works more like a debt fund than it is a syndication fund, where the investors that invest in his fund, they get a preferred return, and that's it. They don't get any upside potential, but that preferred return is guaranteed. So very similar to like a debt, like a loan, except for it's not set up as a loan. They do invest in the fund, but they don't have to worry about losing their money, but he pays them very little. So would a structure like that, you think, would make more sense for these people than a syndication?
I haven't had to use something like that, honestly. Our deal structure and our return profile for every deal is the same. We try to design the deal so it's the same deal time and again. It's that familiarity with the product that we put out, right, and the consistency of the performance and the returns, which that more than anything is what they are looking for. That they know they can just stroke us a check. Generally, one of these guys is like, okay, how much do you need this time? Let me write you a check. He doesn't even look at the deal deck anymore.
Wow.
So just because he knows him, he's invested in 3 or 4 of our deals now. And he knows that we're real strong operators, that, we have stabilized our portfolio for the next 2 years. So we're kind of moving past the debt, this interest rate thing that's going on right now. So I don't need to get into exotic structures. And here's the reason why I don't like them is like, a lot of people want to put out these deals with these waterfalls. I see the advantage of like maybe 1 or maybe 2 waterfalls in a deal structure, but you get more complicated than that. And the fear is a confused mind will say no. So I prefer just to kind of keep it really simple. And just, it's the consistency that works for us. So
Right.
we're pretty generous with our investors anyways. We already give away most of the deal.
So what is your normal, your typical deal split structure look like?
We're doing a lot of 80/20s.
Okay.
80/20 up front, 80/20 on anything above an 8 pref, gets split 80/20. So, the vast majority of the cash flow is going to the investor to start with. And then it's 80/20 on the back end.
Gotcha.
So, and then, we typically have a 1031 sitting there when we exit a deal that people can roll right into and double down on their capital and keep kicking the can down the road. So,
right. Okay.
Yeah.
You mentioned that you do a lot of marketing on LinkedIn. Who do you target on LinkedIn?
When I figure that out, I'll let you know.
Or is it just like posting content on LinkedIn, so you don't necessarily target?
Yeah, I'm actually got a call scheduled at 3:00 today to have that exact conversation. We're drilling down on that right now.
Uh-huh.
And I use, you never heard it from me, but I use the A word, auto and
Yeah.
LinkedIn doesn't like that, and
right.
you'll get kicked off of LinkedIn for uttering that word. Everybody does it anyways, so we're trying to target our audience, and literally at 3:00 today, I have a conversation scheduled with my IT guy to kind of go over that. So
okay. I understand. Okay. So I mean, with LinkedIn, with YouTube, so your main objective when you're making posts on those type of platform is just to be a content provider, like an educator, right? You're educating
exactly
investors on what. Yeah.
I'm trying to. I have a massive sales funnel I'm building, and it takes a long time to do this. I'm using LinkedIn, Facebook, YouTube, my website. I have a VA who is now using ChatGPT when you can get online. It seems like that's been discovered, but there are like 10 or 12 other GPT bots out there that we're starting to explore. We're creating content. We're rewriting content. I have a friend who was a editor for the Associated Press for 40 years. She owes me a lot of favors. So she is, rewriting everything that we produce. I'll give you all a couple of hints about content production.
Yes.
You have to run it through a plagiarism checker. I use 5 plagiarism checkers to make sure that I am not being flagged for any kind of plagiarism by Google. And then you have to run it through an AI checker because Google is now sniffing that out. And Google penalize you on all of that. And you put up all this content and none of it will be found. So it has to be, original content. So that is a massive undertaking to make sure that all the content you put online is
right. So is your, I'm curious now in terms of your process, especially if your VAs are doing it or someone other than you doing it and using these AI ChatGPT type tools. Are they looking for articles that are good out there and then rewriting those articles and then running it through these tools?
Try not to do that, honestly. That is just raw plagiarism. But what we're looking for is ideas. And so, we might, I have a bi-weekly, probably twice a week, I have a call with my VA to go over the latest ideas that I come up with and that he comes up with for, content for an article. and then we'll get to work. We'll throw it into Chat GPT, or any of these AI content writers. You have it. It's a game, and it's both an art and a science as to how you ask the bot to produce the article for you.
Right.
And generally, you got to ask the same question about 5 times different ways in order to get enough, flesh out the article well enough that you can actually produce a 500 to 700 blog post. That's 500 to 700 word blog post. So, we're kind of figuring that process out right now. It's like, it would be great if it would just spit it all out, 700 words on this topic. It doesn't do it. It generally will spit out 2, maybe 3 paragraphs. And so, you copy, you paste, ask it a different question. Maybe it spits out some additional content, copy, paste, get it all in a Word doc, send it off to my editor, have her wordsmith it, put it together, make it logical, run it through both the plagiarism and AI checker to make sure it's, passes that sniff test. And then the final check is we then run it through a search word optimizer so that we input all the requisite search terms that Google likes to see, so that you can climb in the search ranking. So it's a very laborious process to produce a blog post.
That's really cool.
We've optimized it as best we can.
Right. That's a really cool process. Do you have tools that you use to help you generate the topics? Like, are you picking, hot topics for that week, that month? What's your process in picking the topics? Do you do that through research, or do you use a tool that does those kind of research and just give you those topics?
I don't think there's a tool out there for that, but I try to keep them currently topical. Let me put it that way. So, one I started working on yesterday is like, what's the status of multifamily in the first half of 2023? I mean, right now it is really, really challenging out there. And I can't tell you the number of deals I've heard about that are going back to the bank. It is a lot of operators you can drop a pin anywhere in this country and you'll find an operator who's in deep shit. They are in trouble and they can't make, pay their mortgage.
Wow.
Because, they bought at the top of the market. They had frothy underwriting assumptions and they're screwed. So, how does that impact, the rest of the industry? Guys like me who kind of get out in front of it, feel that impact. What does it do to the industry as a whole? How does it tarnish the reputation of the industry? I mean, I can't tell you the number of conversations I've had. It's like, oh my God, it's 2008 and 2009 all over again. It's like, no, it's not. It's not even close to being the same. But, if you're not dealing with this day in, day out, fear takes hold. And so I've got to walk people off the ledge when I have these conversations. So, I thought I'd just put out a couple of pieces of content around that just to get out in front of it. So that's kind of how I think about it. I generally try to keep it topical and current. And then, I have the basics, basic educational resources, what's a cap rate? How are assets valued? So you've got to have the kind of the foundation built for education on your website. And then, from there, I'm figuring it out as I go along, but I just want to keep elaborating on current topics. Right.
Okay. Can you give us a couple names of some of these tools that you use other than ChatGPT? Like Simon asked a question of what's the name of the plagiarism checker tool that you use?
So the one I like is Copy Leaks. I like that one. Okay. I have a little subscription to that, but there's like Grammarly has one. There's this wonderful thing called Google. And you can just Google these things and they pop right up. There are 4 or 5 that I've come across. I don't remember the names off the top of my head, but those 2 come to mind. I did a little research. I think Copy Leaks is pretty good value, and they seem to do a pretty good job. So
that's good. Okay, and then so let's talk about the market condition. You mentioned about a lot of people are getting themselves in trouble. How are you? I expect with the deals that you have, did you get into any bridge debt type of deals,
Yeah,
and
we did.
how are you navigating through that for yourself on your own
Well,
deals?
trying to think if we have any on bridge lending still. I'm sure we do. In fact, I know we do. So what you do on a bridge loan is you buy a rate cap. And so we bought a bunch of rate caps just to give your listeners an understanding how rapidly the market conditions change. We did one deal where the rate cap was $25,000. The next deal we did about 4 months later the rate cap was $1 million.
Wow.
That's how fast the market changed. And so the rate cap fees have pulled back since then. But candidly, we're not even doing bridge debt anymore. We're doing bank loans. We're locking it in at a fixed rate.
Right.
I'm just, the bridge lenders, they're all out of Wall Street. They're hyper aggressive in their terms. They, we'll see. I can wait longer than they can. They gotta lend money. Right. I don't have to borrow it from them. And I have alternatives. So that's how we're playing it. The last 2 deals we did with a bank.
Gotcha.
So.
Okay. How long are you buying your rate cap out? And I guess the more important question is, in the next year, 2 years, do you expect, I guess, a lot of people that have their rate cap expiring on them? So how are you preparing to take advantage of that?
I'm lining up a shit ton of money to buy those deals.
Right.
That's
What's a good way to
says, when there's blood in the streets, that's when you'll find opportunity.
What's a good way to find these deals? I know you're posting content about rate cap stuff. Yeah. Is there a list that we can buy, or a way that we can position ourselves such a way that we know about deals that have rate caps expiring, that we can be in front of, market to them somehow?
Yeah, good question. I'll try to give you the best answer I can, because the circumstances for us are different than they are going to be for people who are just getting in the industry.
I see.
Banks are calling us directly and asking us to take over these assets.
Oh, wow. Okay.
Yeah. So we were just offered a 1,000-unit portfolio across the street from one we own in Southwest Houston. It's a very troubled asset. There's a ton of deferred maintenance. This operator came in the Houston market and bought a bunch of product in the last 2 years. And he's losing all of it. Whoa. All of it. And so the bank called us. I think he paid around $150, $120 a door for that asset. The conversation with the bank, the price started at just the debt on the property. Equity is gone. Wow. Fees are gone. All that money is gone. So all of his investors' equity is evaporated. Wow. The negotiation started at $55 a door. And we countered at $45 a door. The bank has to carry the note on our terms. They have to provide equity for the deal. And we get to keep all of the tax benefits and all the profit. Wow. So that's good. And good for you, not good for them. So I guess what I'm saying is, we're one of the top 4 or 5 operators, maybe 10 operators, let me put it that way, in Houston. I mean, we own a lot of doors down there, so we've got a pretty good street cred. And banks, I can tell you, they don't want a repeat of 2008 and 9. They want these things off the books as fast as possible. So they're looking for any kind of a workout they can kind of put together ASAP. And, because a foreclosure process is minimum 18 to 24 months, and it's incredibly expensive. and someone's got to service that note. And if the operator defaults, that puts it on the bank.
Right.
So the banks don't want them. So they're willing to take the haircut. They can't use the tax benefits anyways. They can't use them. So they might as well give them to us.
Right.
And then they don't need to make a profit. They just need to get out from underneath this obligation.
Wow.
So we'll see if they nibble on that, but we're testing the waters of how far we can push them. And, we won't get it all, but, we'll probably get a pretty decent deal put together. So,
Right.
I know we just made an LOI. We offered on another deal recently. We're probably gonna, we own a small portfolio in a different location than Houston, and that asset, when we're done, it was a 2-deal portfolio, 500 doors. I think we're probably going to push that to 85 or 90 a door when it's all said and done. We just offered on a 600 unit portfolio in that same location. And I think we came in at about 56, 57 a door on that. And believe me, that owner, his basis is a lot higher than that. So,
Wow.
So we are seeing it.
That is crazy. Well, I'm here in Houston, and a number of us here on the line are also here in Houston. So if you need feet on the ground, let me know.
Now I have 125 pairs of feet on the ground down there. So
that's good. I like that. So, with this upcoming market, in terms of the market that you're going after, is it any different than the markets that you were targeting prior to all of this interest rate hikes, prior to this market change?
Are you asking if we're targeting different locations? Or?
Correct. Yeah. Are you?
That's another insightful question. It is really hard to build a footprint in a new location. It is. I have a side hustle deal in Mississippi that I'm working on, and it is just, think a guy like me with all my experience would have known better, but it has just been torture to get good labor on that project. It is a lot of sleepless nights trying to get it, people to do what they say they're going to do in the time frame they say they're going to do it. I ended up firing the first owner's rep I had and the first contractor. Real delays in the project. I've got now a good contractor and a good owner, pretty good owner's rep on board when he decides to call me. And so labor is the big challenge in all these. I mean, multifamily real estate is an operationally intensive business. And we can all play games in Excel all you want, project all this profit, but unless you can execute, you don't have anything. And so the real challenge is having we're vertically integrated. So we are not only deal sponsors, we're the asset managers and we're the contractors. We have it all in-house. We have all of our labor under control. We control our supply chain because we have direct vendor relationships with suppliers in India and China. It's all shipped in containers to the Port of Houston. We send our driver down there, he picks it up, he hauls it off to our warehouse manager, unloads it, categorizes it, catalogs it, and racks it until we need it. So we've tried to control everything on the expense side of the ledger, but don't kid yourself. This is a very operationally intense business. And until you control your operations, and you can play games in Excel all you want, but you haven't got anything. And if you're trying to do it all through third party, you're paying all the, they get to make a profit. So, I know that we do our unit turns, and we do big, deep unit turns. We're very opportunistic value add guys. We're spending 17, 18,000 a door on the turns. For anybody else who's trying to do that all through third party, that's 35 to 40,000 a door.
I see.
So you have to develop systems to make sure that you've got that all in place. You've got to do strategic hires so that you've got crew chiefs out in the field, and you've got regional managers who are managing all of this. And so it's a pretty big business model. And it took a while to build it up. So, but that's how you make money in this business, is controlling your operations.
I see.
You can't tell.
That's good. How big is your team, and what role do you mostly play?
We have about 125 people on the team now. Everything from the C-suite on down to, the turn guys out in the field. They have a lot of, and it's like 60-40 asset management and construction. Okay. Maybe 50-40, and then maybe 10% up in the C-suite. But, we spend a lot of time hiring the right people and make sure that they're real good team members. And then we spend a lot of time, working, you can work the deal out in the field, but you also got to work on the business. So you've got to acknowledge the people who have on board. We do a lot of like monthly events just for the employees. Bowling parties, birthday parties, recognizing the employee of the month. We spend a lot of time thinking about that, not because it's strategically is better for the business, but something we want to do. These people work hard for us, and we want to acknowledge that. Everybody wants to be acknowledged, and we're happy to do so, really, because they're the glue that keeps this business running.
Right. Okay. And then what role do you mainly play?
I do, I'm sort of at a high level guy. You'd think I'd be out in the field running traffic, but that's not the best use of my skill set. So I do a lot of capital raising. I am setting the table for a lot of money to come through the door. So I spend a lot of time thinking through the problem. I'm pretty much the guy charged with automating the process in our firm. So I have spent, a couple of years trying to figure out this mousetrap, and I'm finally getting somewhere with it. It's a big puzzle. And so I finally am understanding kind of all the parts and pieces that go into it. And now I'm executing on it. I bet you I have another 4 to 6 months to go just on the execution alone. But at that point, I'm hoping that, it's running 24/7. I'm trying to get touches with people. And look, you have to take the long view with capital raising. You can't just like meet somebody and have them cut you a check. It doesn't work that way. You've got to have multiple touches, multiple introductions. They have to get educated. They have to learn your background. They have to vet you, vet your team. That takes a while. And so I've had people cut me a check right away, which is unusual. And then I've had people finally cut me a check after a year or two. So I tend to think that it just takes a while to court investors. So it's a numbers game for me. I just need to get as many people coming into my sales funnel as I can and start that ball rolling. And so the goal is to just really play a numbers game. And not in an inauthentic manner. You want to be authentic in this business. But, the more people you meet, the greater the likelihood you'll get some of them to convert,
Right.
So.
Right. That's good. So, for those that are starting out new, do you recommend that they do similar to how you started out in terms of partnering up with an experienced operator, find a way to get into that deal somehow as a co-GP and learn it before they start to sponsor their own deals?
Well, so it seems like a lot of the people getting in the raise game haven't got any interest in being an operator, which is that's a way to earn a living. I don't have any problem with it. It then becomes one of burnishing your creds, getting credibility, and then approaching operators to see if they'll bring you on their capital raise team. I personally think it creates a bit of a conflict of interest when you pursue that model, because guys like me don't want just anybody raising on my team. I get approached all the time, and 90% of them are 95 or nope. So as you get into it and you get more no's and yeses, There's certain there, a sense of urgency kicks in, and you maybe cut corners and don't vet the operators as thoroughly as you should. And you start raising money, and then all of a sudden you're caught between the investors you bring into a deal and an operator who potentially isn't performing the way they thought they were going to perform. So now you personally have to answer to your investors. And I personally never wanted to be in that squeeze. So I prefer to sponsor my own deals for that reason, because I can control kind of how the deal goes. And I can I work a lot with my partners who, I'm older than them, but doing this a lot longer. And so they rely on my wisdom, from all the mistakes I've made, to kind of guide them through some situations. It's a good kind of sounding board, and I like kicking ideas around. So that's one thing I think people who are thinking about getting in the game should think about is, do you want to be in the operations side or not? If not, it seems to me, I've never been in that boat, but it seems to me it's a bigger challenge, because look, people raising capital are a dime a dozen. They really are. There are hundreds of people, thousands of people out there trying to raise capital for deals. And so how do you stand out from the crowd? How do you present yourself to operators as a credible capital raiser? I know one deal I'm thinking of, we had these clowns raise capital for us. They promised us the sun, the moon, the stars, said they could raise all this money. The exact figure they said was, we can raise $17 million for this deal. They showed up 11 million short at the closing. And so that hurt. And it was the first deal going down in the country at the beginning of the pandemic. We had to run out and find a mezz piece at 10% interest and service that debt during the entirety of the pandemic. And oh, by the way, you remember there were eviction moratoriums in place.
Yeah.
So none of our tenants were paying us more, their rent. And oh, by the way, the sellers who we bought it from were jackoffs and didn't tell us we had 125 gangbangers in this one asset. It was a center for crime activity in this area of Houston. So, we're trying to scramble and figure this problem out. Eventually, we got all those gangbangers out of the unit. Remarkably, they all had electrical panel problems, and they had to vacate the unit. And we had to hire security guards to patrol the property 24/7. So, there was 50,000 a month we weren't counting on.
I see. Wow.
But look, we got it done, and we refied, and that's one of our better performing assets right now. So back to what I was saying is, you got to decide whether you want to be an operator or not. If not, you're just going to be a capital raiser. So you have to come across as very, very credible, which means you have to have systems in place. And for me, you have to have a track record. So how do you get experience when you can't get the experience? It's that age-old conundrum, That's why I chose to partner with operators when I did my first deal, so that I could gain the experience.
Right.
So maybe you find a smaller deal that you go kind of in on with a, not a big operator, but you guys try to get it done and move on to your next one and do 3 or 4 deals. And next thing you know, you got the experience.
Right.
So that's a great way to get going in this business. So.
Yeah. Yeah. I agree. I think smaller deals are definitely easier for sure.
Yeah. You're not going to come in this business fresh and do 1,000 unit portfolio, guys. It's not going to happen. I would never even entertain the thought of bringing you on that deal. So, but it's okay to be where you're at. And look, this is a career path, and it takes years to kind of evolve into this business.
Right.
Do it slowly, do it correctly, and you can become pretty wealthy,
right.
But you got to be willing to grow in it. You don't have to get it all done today.
So, with you doing much bigger deals, looking for bigger check writers, what's your big goal? What are you trying to get to?
No, boy, I don't really know. We want to get $1 billion under management. I don't know. At a certain point, it's all, Bill Gates says it's just all hamburgers after a certain point, and I am starting to get to the point where it's like, I need to start thinking about wealth preservation. I'm kind of beyond, get a couple of deals done. I'll be beyond the growth phase of my business. And so then, you get into just the management phase of it. And, I'm 63, so I'm tired of working 60-hour weeks. And so I have a bucket list that I want to accomplish. And, if we can get out of this current, economic environment, and pandemic seems to be tapering off, at least in this country. Maybe this hot war in Europe will settle down. Maybe I can visit, travel a little bit. I've got 5 grandkids. I want to spend time with them. I've got folks I haven't seen in a lot of years who I want to visit with. And I've got like 10, 12, if I'm lucky, 15 good years left. And, I just want them to be productive years. So,
yeah. Gotcha. That's good. So, with you at 500 million asset under management now and growing to $1 billion asset under management, yeah, I mean, those are huge numbers. I know when I first got into this industry, I was thinking even $100 million asset under management was huge. What words of wisdom do you have for those that think it's too big, that don't, that perhaps at a place where they don't think that they could, achieve such big numbers?
You get there faster than you think, really. And look, if you build an enterprise like we have, your acquisition criteria grows with it. So like, there's no way I can look at a 100-unit deal anymore. I can't have that deal support the labor that I put on the project. So our acquisition criteria is like 200, 250 doors minimum in order to support the labor we put on the project. I have $70,000 to maybe $100,000 in just, payroll on a deal like that. So I've got to, and you can't, I mean, if anything less than that, it's a poorly managed asset. And to deploy labor on smaller projects, maybe you cut the labor in half on a 100-unit deal, it becomes massively inefficient for us to operate that deal, because now what I have to do is take that same asset manager and maintenance tech and spread them over 2 properties. And it's just really inefficient.
I see.
So as both myself and my partner both went to engineering school at Michigan. So we think a lot like engineers about how to maximize our efficiency. It's just a hell of a lot easier to buy a bigger deal. It's like 50% less closing costs, for instance, and 50% fewer raises. So, so we buy, a $250 million deal. Well, you buy a deal that size, or not 250, but 250 door unit deal. I mean, that's a $35 million deal all day long, plus, the raise and everything. You get up to 40, 45 million. You do 2 of those. Next thing you know, you're at $100 million.
Gotcha.
It goes pretty quick. So you
That's
grow
good.
into it, believe me.
Gotcha. That's good. All right, Mark. We're going to be wrapping up this part of the show today. If the folks listening in wants to reach out to you, connect with you, invest with you, potentially partner with you, where would you like to send them?
You can go to my website, which is sgreinvestments, plural.com. That's SGRE is short for Shuler Group Real Equity. And you just hit me up, info@sgreinvestments.com.
Awesome. Okay. Well, Mark, thank you so much for doing this interview with me today. I really appreciate you. So thank you so much, Mark.
Thanks.
Awesome.